If you think I'm being hard on them, get ready. Shots are about to be fired. These shots were fired before I started shooting back.
And if you're watching other YouTubers out there telling you, well, they're going to do the robot taxis, they're going to do the home robots, they're going to do the $25,000 car, they might not do any of those. They say they might, the tunnels.
Okay, ladies and germs, I want to do a video about something a little bit different. There's this YouTube channel, Everything Money. These guys are, quote, value investors. They do their own analysis of stocks. And they did a video recently where they, quote, analyzed Tesla stock, and they didn't make a whole heck of a lot of sense. But let's dive in a little bit. I want you to listen to a little bit of what they say, and I'll offer critiques as we go along. So here's the Everything Money channel. Short hint, I don't think they make a lot of sense, but I'm going to break down what they get wrong. They have their method of applying analysis to stocks, and they make some critical errors in analyzing Tesla. Are you ready? Let's go.
In this video, you will get our thoughts as value investors in looking at Tesla as a company and its stock price.
So they're going to look at Tesla and its stock price. We'll see how they do. There's more coming. Right here, you're going to see a critical error that I'll explain after they speak that shows they don't really understand the industry they're talking about. First of all, they think they're talking about the car industry. Those of us who are Tesla fans know Tesla is more than just a car company, but their understanding of the car industry is shown here to be questionable at best.
When you get to a certain point, I can see Tesla selling 5 to 10 million cars a year. And I wanted to say, you mean out of 14 that are, how many are sold?
Well, that's in the US, 14 million new cars. So correction, it's 17 million new cars in the United States are sold every year. Can Tesla sell 5 or 10 million new cars a year worldwide? There's over 50 million cars sold per year worldwide that are new.
So first of all, you could see they were getting the number wrong for how many cars are sold in the United States, and they caught their error and recognized it was more the United States. And then the second guy realized, wait a minute, Tesla sells cars in other countries. So we shouldn't really limit Tesla to the number of cars sold in the United States when they sell cars in China and Europe and other parts of the world. And then he said the world buys about 50 million cars a year when, in the off years of COVID, the number of cars sold was in the 60 million range, 60 to 65 million range, or 66 million. Before that, the peak was 75 million cars a year. So saying that the world car market is 50 million cars when the world car market is probably 75 million cars and growing is kind of weak. Now, we should also be clear that a lot of the 75 million cars are low-end cars that are below the pricing that Tesla has. So that's not necessarily important, but it is interesting that these guys just get facts wrong. You're going to see more of this later, that they don't really understand the car industry. And of course, they don't understand Tesla at all. Now let's hear a little bit about how they think about growth. There's a lot more to growth than what they say, but let's just hear their thoughts first.
Me, and again, the value investor in me, which I was kind of surprised he said this, but the value investor in me says, in order to justify the current valuation, that basically needs to happen. By the time it happens, it says, okay, today's value is good. So that means in 10 years, 20 years, when it happens, today's value is the correct one. Not today's value will grow into that and justify, no, it means today's value. So you're going to be stagnant for those years.
What he's basically saying here is there's this notion that Tesla's going to sell 10 million cars at some point. And they've basically taken the position that when Tesla sells 10 million cars in a year, then it'll be worth the $1 trillion market cap that it now has. This is premised on a misunderstanding of how much a growth company is worth, and we're going to see a lot more about how they don't get Tesla's growth story. But he's basically saying, well, if they grow into a $10 million sales, it's as if they're going to stop selling more than 10 million cars right after that, or it's really not clear how they put that together. They were talking about an interview they did with somebody else where he was explaining Tesla valuation. They just fundamentally don't get Tesla. But let's watch a little more.
And that's the way I look at Tesla. For it to justify its current valuation, it's got to hit home run after home run after home run to even justify today's price. Not 20 years from now price to get a reasonable return. To get 0% return, basically it's got to do that.
So his vision of things is that for Tesla to get to 10 million cars a year, and that's really all they see. All they really see in Tesla is they could sell 10 million cars a year. They don't, a lot of nuances to Tesla they just absolutely don't get. And we're talking about big things, not small things. But that if they, that it's going to require Tesla to hit a lot of home runs to get there. And look, very clearly Tesla has to execute. But it's also very clear that Tesla's about to open 2 new factories, and they have a big cash pile and they're making money, so they have a lot of resources to build more factories to achieve these things. So I don't know that it really requires home runs anymore. Tesla just needs to execute. They basically need base hits. For those who are baseball fans, if you're not a baseball fan, a home run is a big hit. It's a big deal, and you don't get very many of them. But base hits and getting walks and getting sac flies, there's a lot of routine things in baseball. And Tesla doesn't have to hit home runs anymore. They just have to execute. They have to basically play a good game. And they've shown that they're playing a really good game, and the other teams aren't playing very well. So if we're going to use the baseball metaphor, who else is on the field and who else is playing well? I don't see anybody else playing well. But they don't get into, they throw out that metaphor, but they don't really dive into it as deep as they should. In this clip here, we're really going to start diving into their analysis. They have this 8 pillars analysis, and the first pillar is 5-year price earnings ratio. Hear what he says, and then we'll talk about it.
A $1 trillion company, but $935 billion.
So,
Current PE, 270. There is no 5-year PE because in the last 5 years, they haven't made overall money. So our first pillar is we want the 5-year PE under 22.5. It is non-existent.
This is basically saying that they would never support a company that is new. I've invested in Amazon in 2013 when they had a PE ratio of about 1,000 and they had been losing money for years. And I'm up, I don't know, 14x, 15x on my Amazon stock. These guys are creating artificial ways of preventing yourself from getting in. You know, we talk about Tesla's the next Tesla. I'm wearing the Tesla and Air t-shirt, but there's a Tesla's the next Tesla t-shirt. Check out the t-shirts at elonbits.com. These guys have created arbitrary markers that make it harder for them to see growing companies that are very clearly going to dominate their field. And you miss opportunities when you invest in this way. And I find it comical that they came up with this 5-year PE. How about looking forward? You know, where they're not looking forward. What's the PE going forward? What's the forward PE? You've got the PE for the current earnings. What's the PE? We can easily project out what Tesla's earnings are going to be in the next 12 months. And you'll get a PE of around 100. And like I said, I bought Amazon when the PE was like 1,000. PE, is price earnings ratio, the price of the stock relative to the earnings of the stock. And in a typical company, you might look at a price earnings ratio of 25, or I think Amazon's price earnings ratio right now is around 75. Apple's is around 30. So there are, different ways of, different companies in different stages of growth. But typically a fast growing company has a higher price earnings ratio because you're expecting to get more earnings in the future because of that growth. And they really don't see Tesla's growth. You see that throughout this video. They do not see the growth potential of Tesla, both in terms of revenue and in terms of the increase in profits that are coming from the way the business model works. They just don't get it. Now we're going to get into return on invested capital. This is another example of misimplying an important concept. Because they're requiring a 5-year number for a new company that's just started making profits and growing, it doesn't work, but that's what they do.
There is no 5-year return on invested capital. Why? We want it to be above 9%. It's negative because the last 5 years free cash flow is negative.
Why only look at the past? Why not look at the future? It's obvious that Tesla is now making money and they're kind of not seeing, they've got their pillars and they've already got 2 strikes against Tesla based on stuff that would rule out any company that's new and growing and successful. It would rule out it would have ruled out Netflix before Netflix made money. It would have ruled out a lot of Amazon. We've already talked about that. Facebook. You're missing out on really great growth stories if you apply the analysis that everything money is applying. They call it value investing. I'm going to call it head in the sand investing. I don't know. Here's another one. We're going to get into free cash flow. Listen to this.
Because the last 5 years free cash flow is negative. But last year's free cash flow, $2.56 billion, which means right now they're selling for about 37 times last year's free cash flow. We want it to be around 15 to 20 for 1 year.
He's got these arbitrary numbers. We want the price related to free cash flow to be 15x, 20x. He's got these numbers that ignore the growth potential of the company. If you have a fast growing company, your multiples should be higher. And he just has these arbitrary numbers in his head that rule out a company that is generating massive cash flows. And he can't see that opening Giga Berlin means that margins are going to go up because they don't have to transport vehicles from China to Europe or from Fremont to Europe anymore, that they're not going to be paying tariffs on bringing vehicles in. He doesn't see that the factories are getting more efficient, that the shift from Fremont to Shanghai, Berlin, and Texas is going to lower the unit cost, that the going to front and rear castings and structural pack, that the use of lithium iron phosphate batteries, that a lot of things that Tesla is doing are going to reduce cost per vehicle sold, and then also ignoring the potential for full self-driving to increase the top line revenue which has basically no cost. They're already putting all the equipment in the cars. There's basically no cost to Tesla to have more people start using full self-driving. So if full self-driving takes off, that's another kicker to Tesla's growth. I'm leaving out robotaxi, and there's so much more that's being left out here because they just don't fundamentally understand Tesla. And this is one of those things that I would say a larger point here is, if your vision of how to analyze stocks is you just take what these guys do, they have their software, they slap numbers in, you have to understand the company. You have to genuinely understand and dig deep on what this company is, what this company does, what this company's business model is going forward. And you see it again and again in this video that they do not get what Tesla is about. Next, we're going to talk about revenue growth. Tesla has a lot of revenue growth. They're going to miss it, but listen to what they say.
Now, here's the exciting part about Tesla. Let's go to the income statement of our exclusive software. Look at this revenue growth, kids. In 2012, they did $146 million in revenue. Last year, $46 billion. This is huge. This is what gets people excited because all they say is, oh my God, look at this growth. This is going to $500 billion. And it might. It could go to $500 billion. Toyota does hundreds and hundreds of billions of dollars in revenue. Great. It could go there. But will it go there? I don't know.
So their picture of revenue, they acknowledge that Tesla has grown revenue very dramatically, but he seems to think that the revenue growth is just going to stop or tail off when those of us who are watching have noticed that revenue is growing really, really fast still. Tesla is growing very, very fast. They're growing deliveries. They just increased deliveries from 2020 to 2021 by 88%. That's a very, very fast rate of growth. I think their revenue for 2021, they're doing the last 4 quarters, which doesn't include Q4 because we don't have Q4 revenue numbers. But I believe we're going to see revenue numbers for 2021 in the ballpark of $52 billion, $54 billion, which is significantly higher than the number he just gave because he's missing that Q4 was another big number and that big number delivery number. And honestly, the average selling price of the cars is probably up. So the revenue number is probably going to be even higher than I expect. We also don't know how many mega packs they delivered. We don't know what else is going on. So there's a lot of good news here for Tesla. And he seems to have this arbitrary notion that Tesla won't be able to reach $500 billion in revenue. Well, you see the path. You see the fast growth. What's stopping the growth? And he doesn't see it. And by the way, I think $500 billion is a very low number for Tesla's future if you factor in things like robotaxi, especially if you factor in Tesla Bot. But even on just selling cars, yes, they can get to 500 if they sell 10 million cars a year at $50,000 a car. They're there, right? But what if they sell 20 million cars at $60,000 a car? Then they're way over this number, and he can't even conceive of the possibility that Tesla will outperform his simple numbers. Can't even conceive of it. Next, he's going to talk about profit and price earnings ratio. Let's check this out.
So let's go to the net income. 5 years ago, they lost $1.4 billion. Last year, they made 3.4. That's a check mark. That's pretty legit. Okay. We're on the right path here. We're getting somewhere better. Again, does it mean for a company to be worth $1 trillion, it essentially needs to make at 15 times $60 billion a year in profit. So using the same ratios, this has got to grow by 18 times. Well, if it takes 18 times this profit to make it justifiable, the revenue, 18 times more of $46 billion would take the car company to, what is that, $600, $700, $800 billion in revenue.
What he slipped by there was he assumed a price earnings ratio of 15. A price earnings ratio of 15 is for a company that's not growing or growing very little. Amazon's price earnings ratio last time I checked was like 70, 80, 90. Apple's price earnings ratio 30, 40, I forget the number. Tesla's price earnings ratio, if they achieve the numbers we're talking about, is probably going to be in the ballpark of 50 or more. So with a 50 price earnings ratio and you want to get $1 trillion valuation, you only need $20 billion in profit, and they're going to be at $20 billion in profit probably in 2022. People do not grasp how quickly Tesla's profit is growing. It's growing really fast. He can't see it. He just can't see it. The change in margins as you as you build factories that are close to your consumers and close to your supply chain. So you're reducing your supply chain cost and you're reducing your cost of delivering to the consumer. You're delivering to the consumer more quickly because your factory is closer to the consumer. You're avoiding tariffs. You've come up with more efficient ways of building cars in the new factories. There's so many advantages to what Tesla's doing that's going to increase profitability, and he just has no clue. He doesn't see it because he's not diving deep into one company. He's trying to apply this 8 pillars system of analysis, their software, to every company under the sun without really diving deep and understanding how does this company work. Because he doesn't get it, he comes up with bad numbers, and he's so confident about it, it's comical.
And if it does happen in the future, you might sit there and say, if I had a crystal ball and God came down and said, Paul, Tesla at its peak will make $60 billion a year in profit, I'd be like, okay, then I'm not buying Tesla. But Paul, just if I say, exactly, I'm not going to get no return on my money. I'm going to pay $1 trillion today for what it needs to do in the future to justify today's price.
This is what he's caught up on, is this notion that, first of all, somehow Tesla's going to reach 60 billion and stop growing its profits. How much does he think profits will be if they complete a robotaxi network? He has no concept of the potential for a robotaxi network. He has no concept of how much profits Tesla might make from Tesla Energy, which is going to be growing very fast now that they've built a Megapack factory. We're going to see significant increase in Tesla Energy revenue. There's so many things going on here that are improving Tesla's numbers, and he just doesn't see any of it. He doesn't see the potential for FSD increasing margins. He doesn't see the potential for robotaxi. He doesn't see the potential for Tesla Bot. He doesn't see the potential for Tesla Energy. He doesn't see the potential for Tesla AI training with Dojo. So many different things happening at Tesla, just zero clue, zero interest really. For him, it's just a car company. They make cars, they make margin on cars, and that's it. He can't see beyond that. You're going to see more of that later. Here's a little summary of the 8 pillars so you can get this before we go forward.
So guys, here's the 8 pillars on the 8 pillars tab. I mean, it's just awful.
So you can see they've got their 8 pillars, and a bunch of them are negative because of things like they don't have a 5-year history that's good because they haven't been making profits for 5 years. I just find this a really dumb way to evaluate companies, and you think of all the great companies you miss. Netflix and Amazon are 2 great examples of this. You miss a lot of potential when you do it this way, and I guess if you don't want to hit home runs, this analysis might work for some companies, but if really it doesn't work for any company if you don't dive deep and understand. If it's a really simple company, it's really straightforward what the company does. They're not particularly innovative. I suppose this works, but when you're in an innovation space like Netflix and Amazon and Tesla are, and Facebook and Twitter, the social media companies and everything, Apple's in a very innovative space. If you don't understand the innovation, why are you stepping in and offering your analysis on something you don't really understand? I don't know. So here's where they go through their stock analyzer tool. This is something that they sell. This is how they really make money. They don't so much make money on YouTube ads. They make money by getting people to buy this stock analyzer tool that lets you do the same kind of analysis they're doing in this video. If you want to use their tool to badly analyze fast-growing high-tech companies, then I suppose you can. I'm going to say probably not the best choice, but you got to make your own choices.
Oh, we think Tesla's going to be around for 10 years. Let's put a 10-year analysis in there. All right. Give me some revenue growth numbers, kids. Actually, let's do this. Can somebody Google and figure out what the 10-year growth projections are for Tesla? Okay. So we're not finding anything on 10-year assumptions for revenue growth, but let's do this. Let's say they're able to sell 10 million cars a year in 10 years. Okay. 10 million cars a year. How much is the average car going to be? What's the average sale price of a car today for Tesla?
40,000.
But for them to sell for Tesla or in general?
Tesla.
Okay, so for them to sell 10 million cars, they can't have really high-end cars. It's got to go more to the average. So
I think the Tesla bulls are saying they're going to come out with this $25,000 car and not have a ton of competition from something like a Apple or...
Okay, so right now, the average new car tops $45,000. This was just 2 months ago.
Do you notice how they keep getting facts wrong? Like 40,000, 25,000. Oh, geez, the average selling price for a new car is $45,000. Now, this misses that Tesla sells cars in other countries. They're looking at the United States. They don't understand that Tesla is a global company that sells cars in Europe, that sells cars in China. The average selling price of a car in China is almost certainly lower than $45,000 because they sell a lot of low-end cars in China. But it's just comical how badly wrong they get everything. Just comical. And by the way, his number that let's suppose they sell 10 million cars in 10 years. Elon is very clear that Tesla is aiming to sell 20 million cars by 2030 and probably sooner than 2030. So that's double the number in a year less than what he's talking about, really 2 years less than what he's talking about. So, his sense of growth is off, but let's listen a little bit more about what he's saying about growth.
So let's say in 10 years, it goes up 2.5% a year. So 1.025 to the power of 10 times 45. That would make the average car in 10 years $57,000 a year. Okay, so let's sit there and do that. 10 million cars times $57,600 per car is revenue of $576 billion. Okay, they currently do $45 billion. Is that what they do right now?
Revenue, 46.
So that is revenue growth of 29% a year on the high end. For them to sell 10 million cars a year at an average of $57,000 a car, it's 29% revenue growth per year. High end, let's go 30. I'm going to go 10, 20, and 30%. How does that sound?
Okay.
I don't think it sounds that good. Tesla grew its deliveries 88% from 2020 to 2021. Tesla has said that they are aiming for an average growth rate of 50% a year for the next 10 years, with higher growth in the early years. This is a massively oversimplistic analysis. Why would you assume Tesla's only going to grow at a maximum of 30% a year when they're currently growing at like 88% a year, 100% a year? Tesla increased deliveries 9x in 4 years. They went from 100,000 cars to 900,000 cars in 4 years. 2017, 100,000 cars. 2021, 900,000 cars. This is a very fast-growing company, and these guys are imposing arbitrary growth limits with no understanding of the business model, and they're only talking about cars. They've ignored the potential for Tesla Energy. They've ignored the potential for FSD. They've ignored the potential for Robotaxi. They've ignored the potential for Tesla Bot. They've ignored the potential for AI training. They have no concept of what this company does and what this company is going to do. Just zero concept. Let's throw some numbers we made up into our stock analyzer tool without really understanding the company we're talking about. And poof, we'll get numbers that will give us the answer we want to tell you instead of actually putting hard work into understanding the company. This is, in my opinion, this is a bad way of analyzing stocks. You should really understand the company before you do this, and they clearly do not understand Tesla as a company. Next, he's going to talk about profit margins. Let's see how this goes. I'm pretty sure it's not going to go any better.
Now, profit margin. I'm going to go 5, 7, and 9 because it's still above today at 9, assuming they have really good way of making more money than the average car company, even though the average car company now does 4 or 5%, and they're doing 7 with government money. So that seems reasonable.
It seems reasonable to assume that Tesla is an average car company, even though Tesla is making insane profits on their cars. Tesla's profit margin is much, much higher than this, and it's going to grow, not shrink. If you listen to Zach Kirkhorn in the investor calls, they are expecting profit margins to grow, not shrink. There's a lot of reasons why profit margins are going to grow. Reason number one is their cost, as I mentioned before. By opening Giga Shanghai, they're able to deliver vehicles to Asia at lower cost. They're able to produce at lower cost. They're able to deliver vehicles to Europe at lower cost because Shanghai produces at lower cost. By opening Giga Berlin, they're now able to deliver to Europe from a European factory, which lowers costs further because you have no transportation costs. I'm beating a dead horse here, but no transportation costs. You eliminate tariffs. So many advantages, and the new factories are going to be more efficient even than Shanghai. So there's so many things going into lowering Tesla's costs. And then you have things like FSD and other things that are going to increase their profits and increase profit margin. And they just absolutely do not see it. They consistently do not see Tesla. A 9% profit margin on a company that I think the last number I saw was 13%. And they say their profit margin is growing, and we can see clear reasons why profit margin is going. But let's arbitrarily assume they're just another car company and their profit margins will be in the realm of ordinary car companies. Seems like a dumb way to do analysis to me, but these guys are the big players, right? So just to be clear, this guy has a very different view of price earnings ratios than I do. He's going to say his opinion on what would be a nuts view of price earnings ratios. Keep in mind, the price earnings ratio he says is nuts is significantly lower than the price earnings ratio that Apple and Amazon have right now. But hey, listen to what he says.
PE. Guys, I'm going to go, when the company's so large, 15, 20, and 25. I'm going to go, hey, all you like Tesla bulls, 25. If you don't believe this PE, if you already think that PE is too low, do me a favor. Unsubscribe, close the thing, write down under there, Paul, you're an idiot, and just move on. Because if you believe that the largest car company in the world should be selling for 25 times earnings when they're the largest car company in the world, you're nuts.
Well, I can't unsubscribe because I didn't subscribe. I would suggest that if you subscribe to this channel now, you probably should unsubscribe. It's his idea, Paul. Thanks, Paul. You're right. You should unsubscribe. Paul, why does Apple have a price earnings ratio above 25? Why does Amazon have a price earnings ratio way above 25? Those companies are both larger than Tesla in terms of market cap right now. So fast growing companies have price earnings ratios larger than 25. Tesla is it's one of the fastest growing companies on the planet. It's a very large company, but it's growing really fast. It's going to keep growing fast because it has a massive advantage over anybody that it's competing with. And I'm sorry, Paul doesn't see it, but if you're subscribed to Everything Money, this is probably the time you should consider unsubscribing because Paul's giving you really bad advice. Makes absolutely no sense to cap Tesla's price earnings ratio at 25. I had no idea that, again, this is the guy who would have told you not to buy Amazon in 2013 when I bought Amazon and I made a killing on it. He would have told you not to buy Facebook at the IPO. He probably would have told you not to buy Google at the IPO. Seems obvious to me he's totally wrong, but, he's got a channel and some people believe in him, so okay. So now we're going to hear Paul's view on what the Tesla share price should be based on his brilliant analysis using his brilliant stock analyzer tool.
And we're going to do the same thing for free cash flow.
Or uninformed.
No, you're nuts.
Okay.
And finally, guys, you want a desired return of 12.5% because you can buy an ETF and make 9 or 10. Let's get 12.5.
Okay, there's a nice assumption there that you can get 9 or 10% on an ETF. That's not a risk-free rate of return in any world. I studied finance for a while. I went to Stanford Business School's PhD program. I studied finance. The risk-free rate of return is not 10%. You may be able to get 10% in some ETFs, but that's not guaranteed, and I don't know where he's coming up with that ETF number. That's a little bit of a stretch there as well. It's an interesting take. That does lead to a lower value for a company. I'm not sure how he got that 9 or 10% number. I think that's an odd take, and I would have to hear more explanation for how he got that. Doesn't sound right to me, but let's listen.
Hit the analyze button.
So we should be paying what price if we want to make 12.5 per year?
Based on Tesla selling 10 million cars a year at $57,000 a car in 10 years, $488 per share.
There you have it, folks. If you're this guy, you should be shorting Tesla because the stock is really only worth under $500 a share. And that's using the rosy assumptions of a 25 price earnings ratio. Okay, obviously I disagree. Obviously, if you follow me, I think Tesla is already worth $2,500 to $5,000 a share right now. My price target for Tesla, my bear case for Tesla in 2030, which is 9 years away now or 8 years away now, my bear case is $8,000 a share. I think you're crazy. I think this guy's, if he thinks I'm nuts, I think he's nuts. For $488 a share, maybe he should be looking at this saying, gee, the market thinks very differently about this stock than I do. What am I getting wrong? We're always wrong. We should try to be less wrong. That's another t-shirt on elonbits.com. We should try to be less wrong. He's not trying to be less wrong. He's assuming he's right. He's assuming he has the right analysis. It hasn't occurred to him. He's assuming he has the correct analysis. It hasn't occurred to him that since the market has a very different valuation of Tesla stock, what might I be missing about Tesla that would change my view? How would I, just for example, maybe I should be thinking about a higher price earnings ratio. Maybe the revenue's going to be bigger than I think. Maybe they're going to deliver 20 million cars in 10 years. None of that crosses his mind. He's not, maybe there's other factors that we could look at. He sees none of that. Next, we'll get into what I guess we could call his bear case for Tesla.
If you assume 20% revenue growth over the next 10 years, still makes them a very large company, but probably selling 5 million cars, 4 or 5 million cars a year, you got to pay $153. 10% revenue growth a year, which is still pretty reasonable, $44 a share.
So this must be the analysis underlying Gordon Johnson's valuation of Tesla. is that in 10 years, Tesla will be selling like 3 million cars. And yeah, I don't know what he thinks that the Berlin and Texas factories are going to be doing. No sense of how he gets these numbers. There's no sense of him looking at this and saying, gee, if Tesla only sold 5 million cars in 10 years, how many factories would that be? How much output would that be? What is the market for Tesla's cars and vehicles? And what else? He has no concept of what Tesla is as a company. It's just repeated, shown again and again and again. It's shocking to see this when you're caught up in our space, when you're a Tesla fan and you really get into understanding the company. And this guy clearly doesn't understand the company at all. And he comes up with these pedestrian tools that just miss Tesla's real fundamentals. He doesn't see it. Okay, so now we're going to get his Super Bowl case for Tesla. You ready?
Doesn't make sense at 48. So what does their revenue growth have to be in order for them to justify current price today? Let's put 40% in. Yep, 40%. So they've got to go and do the same math, guys. 40% revenue growth times $46 billion a year?
Yep.
Times $1 billion divided by $57,000 a car. They have to sell 23 million cars a year to justify today's price and all those other assumptions. They've got to sell 23 million cars per year.
Okay, so if you follow my channel, I think selling 23 million cars is not a big deal for Tesla. That is what their stated goal is for 2030, which is a year before the year he's talking about, or 2 years before the year he's talking about, is selling 20 million cars. And really, Elon has kind of suggested that might be 2029 or 2028 that Tesla will sell 20 million cars. But he leaves out all the other revenue. We know Tesla Energy exists. We know Tesla Energy is going to grow. These guys think that Tesla Energy doesn't exist. Robotaxi, FSD, Tesla Bot, AI training, all these other things that are going on at Tesla that they have no clue about. But, if Tesla manages 40% growth a year for the next 10 years, which, hey, their target growth is 50% a year and they just did 88%. So, maybe it's not so crazy to think they'll get over 40%, Paul. But Paul doesn't see it. We can't make him see it. This is why Wall Street doesn't make sense. This is why a lot of people don't get Tesla. And this is why people like Paul miss out on Amazon, Netflix, and all the other great investments that a lot of people missed out on. Just really quick, you can again see how they misunderstand the global car market.
In 10 years, the current international market's a little over 50 million new cars a year. Currently.
Yeah, a little over 50 million. A little over 50 million. Will that grow? Yeah, probably grow. Way off. Don't understand the global car market. Not a big surprise here. They don't understand Tesla. They don't understand the global car market. They don't understand the car industry. But they have the stock analyzer. It's really cool. Now we're going to hear Paul's deep thinking and the team's deep thinking about what happens in a crisis.
In the last 10 years, there have been no problems whatsoever. The country has been, boom.
Peachy keen.
Peachy keen. By the way, from 2000 to 2010, we had a terrorist attack, we had a financial crisis, and a housing bubble. That's okay, but next 10 years, it'll be nothing's going to go wrong.
Clear sailing.
Everything's going to be fine. 40%, if you believe 40% revenue growth a year with margins double what they are in other car companies, and with a PE of 25. Remember, PEs are justifiable on higher growth companies. And if you think they're going to grow 40% a year when they have half a trillion dollars in revenue, I just don't get that.
That's correct, Paul. You just don't get that. Tesla just went through a crisis. We just went through a 2-year crisis in the world economy. And Tesla just grew their sales from 360,000 cars or something like that 2 years ago to over 900, massively more than doubled their sales in 2 years. So ballpark of 360,000 in 2019. They grew to 934,000 in 2021. That is way more than double in 2 years in the middle of a crisis. When you have a crisis, the best companies grow through them. They do well in the crisis. If we have this crisis that you're talking about, your ETFs aren't going to... Remember he mentioned before, if you throw in your ETFs, you're going to earn 9 or 10% on your ETFs? Well, you're not going to earn 9 or 10% on your ETFs in the middle of a crisis either, Paul. So he's picking and choosing what he analyzes, but you can just look at how Tesla has grown through a rocky period. Tesla has managed to survive all kinds of rough moments, and they've gotten through the worst economic crisis we've had in a while, with the global car market dropping from 75 million cars to 63 million cars, and Tesla grew through that. Tesla grows through a crisis. Great companies grow in the middle of a crisis, and Paul doesn't understand that either because he's stuck with a software tool. He's not thinking big picture. If you think I'm being hard on them, get ready. Shots are about to be fired. These shots were fired before I started shooting back. So here we go.
And if you're watching other YouTubers out there telling you, well, they're going to do this, they're going to do the robot taxis, they're going to do the home robots, they're going to do the $25,000 car, we just sort of remind you, they might not do any of those. They say they might, the tunnels and all the stuff, but they might not do it.
Responsible investing is about being conservative and still buying underneath the conservative numbers. 40% revenue growth for Tesla is not a conservative number.
Okay, so first of all, Tesla doesn't build tunnels. The Boring Company builds tunnels. That's not even inside the company. And here's the mistake that they make. Like, let's step back from taking shots at YouTubers and let's just take a second and say, okay, they've said they're going to do robo-taxis. They've said they're going to do the bot. They've said they're going to do the $25,000 car. They said Tesla has said a lot of things that they're going to do. And what Paul and his team are doing, what Everything Money is doing here, is they're assuming that none of that will happen. What you should do if you're a sophisticated investor is you should say, there's some probability that this will happen and there's some probability that it won't. If you look at how ARK Invest analyzes and you do their Monte Carlo models, they've got a whole bunch of models, I don't agree with their approach necessarily, but they consider a variety of possibilities of what might happen. These guys just assume none of that will happen. So you're assigning zero probability to the company achieving what they say they're going to achieve. A company that has achieved a lot of things that they said they were going to achieve. A company with a CEO who said, we're going to land orbital rocket boosters, and they landed orbital rocket boosters. This is a company that, and a CEO that repeatedly do things that people say can't be done. My bet, never bet against Elon, is a classic line. Never bet against Elon. These guys are betting against Elon. They're not just betting and saying it's unlikely Tesla will achieve that. It's unlikely Elon will achieve that. They're saying zero probability. Their analytics, their method of analysis assumes there is zero probability of robotaxi, zero probability of FSD, zero probability of AI training, zero probability of Tesla making any significant sales in energy. This is a critical flaw. If you are going to do genuine analysis, you should say, wait a minute, what's the probability that they do achieve these goals? What's the probability? And you could assign a low probability, but to assign a zero probability is a really, really strong statement, and they haven't thought that through. I did love the shot at YouTubers. I took it as a shot at me. It's a shot at Rob Maurer. It's a shot at Stephen Mark Ryan. It's a shot at Dave Lee. It's a shot at all of us. Thank you for shots fired. Now I feel a lot better about shooting back. I just particularly like this moment, number one, for what he says, and number two, tell me, not Paul, the other guy that you're going to see, tell me he doesn't look a little stoned. Not that there's anything wrong with that, but tell me he doesn't look a little stoned. Anyway, listen to this.
Point the solar thing that they were supposed to do. Now it's being investigated by the SEC. So it's
why? Because he bought a company from his cousin.
Yeah, something like that. But it's just more of like, they're going to do this. They're going to do this. They're not doing solar right now. So
yes, Tesla is doing solar. They're selling solar panels. They're selling solar roof. That business has been growing slow. They've really been waiting for being able to grow Tesla Energy. They've really been waiting to get over a hump with the cars so that they can get going on Tesla Energy. But they just opened a Megapack factory. Tesla is doing solar. They are doing energy. They never mentioned Tesla Energy. They never mentioned Megapack or Powerwall at all. They never mentioned AI training. They never mentioned, most of the stuff that Tesla is planning to do in the future doesn't even exist on their minds. But I just find this guy funny that they're not doing solar. Yes, they are doing solar. They've been doing solar. They haven't scaled solar yet, but they are doing it, and it will scale at some point. We'll see. It's not a high priority because they got to get Model Y going, and then they got to get then they got to get the battery day vehicle going. They got a lot of things on their plate, but it will happen. And Drew Baglino talked about a flotilla of batteries coming. That flotilla of batteries is going to be going into Megapack. Megapack's going to be going out to utilities very, very soon in very high volumes. That's going to be a significant addition to Tesla revenue and profit. A lot of things going on here. These guys just don't get it. So I want to thank the Everything Money channel for giving me a chance to rant about how dumb their analysis is. I am a Teslaanaire. I am somebody who owns or aspires to own $1 million in Tesla stock. I actually own more than $1 million in Tesla stock. Please check out the Teslaanaire t-shirt. This is a monster selling t-shirt on elonbits.com, so check it out. There's Tesla's the next Tesla. There's Be Less Wrong, which I really should send a Be Less Wrong shirt to the guys at Everything Money because they got to be less wrong. Check out my other videos. Please support this channel on Patreon. Thanks to the Vasa Law Firm in Sweden, all my other Patreon supporters for helping the channel grow. Thanks to my supporters on the Locals platform, The Daily Lie. Please support this channel on The Daily Lie. Join the YouTube channel as a channel member. And thank you so much for watching.